All right, today we're going to pull back the curtain on a really powerful and, yeah, pretty popular financial tool that lets you play in the world's markets without ever having to own a single thing. Let's jump right in.
So let me ask you this. Have you ever thought about trading gold, but without the headache of, actually buying and storing a heavy gold bar? Or maybe you've wanted to speculate on a huge tech stock without forking over the cash to own even one share. If that sounds familiar, then you are in exactly the right place.
The way this all works is through something called a contract for differences, or CFD for short. And really, at its heart, CFD is just a simple agreement between you and your broker. You're not buying anything real, you're just making a bet on which way the price will go, and you agree to settle up on the difference later. Simple as that. Okay, so that's the what. But what about the how? How does one of these trades actually play out from start to finish? Let's get into the mechanics. It really breaks down into 3 easy steps. First, you open your position. Second, you wait for the asset's price to move. And third, you close the position. And here's the most important part. Everything, and I mean everything, is settled in cash. You get paid your profit, or you pay your loss. No trucks delivering gold bars, no stock certificates in the mail. And this brings us to what makes CFDs so incredibly flexible. If you think the price of something is going to go up, you go long. But, and this is huge, if you think the price is going to fall, you can go short. That means you have a chance to profit whether the market is booming or busting. Now hang on, because there's one more feature we need to talk about. This is the big one. It's kind of like a supercharger for your trades. It's the one thing that explains both the incredible appeal and the serious, serious danger of CFDs. And that feature is called leverage. The best way to think about it is like a literal lever. It lets you use a tiny amount of your own money to control a much, much larger position in the market. Let me show you what I mean with some actual numbers. Okay, so let's say you've got $500 of your own cash that you're ready to put on the line for a trade. Now, normally, if you were just buying a stock, your $500 would get you, well, $500 worth of that stock. But with a CFD, that money isn't your total firepower, it's just your deposit. With leverage, that same $500 could control a position worth $10,000. And right there, you see the appeal, right? A tiny price move on that $10,000 position could mean a massive return on your initial $500. Your potential profits are just amplified. But, and I really can't stress this enough, this is a classic double-edged sword. That amazing power comes with a dark side. This is where we have to talk about the real risk. Because here's the unavoidable truth. Any amplifier, any supercharger, it works in both directions. The exact same power that blows up your gains can blow up your losses just as fast and just as brutally. And that leads us to the single most important risk you need to understand. I'm going to read this directly. Losses in CFD trading can exceed the initial investment. Let me say that again because it's crucial. You can lose more money than you started with. Let's make that real. Look at the chart. You started with your $500. But remember that $10,000 leveraged position? If the market moves against you, your loss is calculated on the full 10 grand. A small dip could easily create a $750 loss. Not only have you lost your entire investment, you now owe your broker another $250. So when you look at that, this wild dynamic of huge potential rewards and equally huge potential risks, you have to ask, who on earth are these instruments actually for? And the answer is pretty clear. CFDs are not for beginners. They're not for casual investors. They're for experienced traders who are glued to their screens, who have solid, tested risk management plans, and who really deeply understand how these markets work. This is not a set it and forget it kind of thing. So at the end of the day, a contract for differences gives you amazing flexibility and the incredible power of leverage. But that power cuts both ways, with equally magnified risk. Which leaves us with one final thought, one last question for you. You've seen the power and you've seen the risk. Are you truly prepared for both?